Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Managing Director and Head of Fixed Income Research, Tom Tzitzouris. Tom, how are you doing this morning?
I'm doing great. Thank you for having me on.
Yeah, thrilled to talk to you. Obviously, very timely as well. We've gotten a lot of inflation and economic data this week, including the all important CPI report on Wednesday. We're talking on Thursday morning, but I'm curious if there was any big takeaway from either the report or the actions of bonds and yields in the aftermath of the report that was especially interesting to you.
Yeah, so really quickly, I mean, the most important points from this week are that one, the CPI number did come in lower than it was last week, and that's obviously a modest improvement, and that's a moral victory for those who are hoping to see inflation dip lower. But other inflationary measures were a bit mixed this week. Earlier this week, we had producer price indices, which showed a softer inflation the prior month, revised lower, but higher inflation this month. So it's been mixed. We also had import prices come in earlier today. Those also suggested that there was some import price pressure. So broadly speaking, everybody is focusing on the CPI number, which is perhaps the most important number. But broadly speaking, the inflation picture this week was actually fairly mixed. And when we saw those import price numbers come in this morning, you did see the bond market begin to sell off, kind of putting a stop to what had been a pretty strong rally over the last 3 weeks.
Yeah, I think that comes together in this idea of inflation heading lower, but proving sticky and increasing the calls for what should be a higher for longer interest rate environment as the Fed battles that inflation. Another piece of the higher for longer interest rate call is the increasing issuance of debt and questioning the market's ability or willingness to accept all of the US debt that's coming out. You've been covering Treasury auctions a little bit more closely because of this kind of changing of the guard, and I'm curious what you're seeing on that front and whether the market is absorbing the debt well or if it's proving problematic.
Well, just like the inflation picture, the Treasury auctions have been mixed. You'll have a good auction 1 week, and then 2 weeks later, 3 weeks later, you'll have a similar maturity auction not go off so well. And we're seeing more or less a one on, one off. And what that tells us is that the demand is not stable. It requires really essentially weak economic data for the bidders to come in and to gobble down this supply. If the data remains strong, particularly if the labor market remains strong and inflation numbers remain higher than expected, then the demand does not materialize as hoped at these auctions. So it's been on, off, on, off. And it tells us that the supply is going to continue to be a problem for the bond market and really global financial markets for years to come, because the Treasury is going to have to raise, particularly coupon auctions, no later than middle of next year. And that's going to be hard to digest once again.
Yeah, and again, playing back into that higher for longer interest rate theme, sticky inflation, more difficulty digesting Treasury supply. But I do want to quantify that a bit because obviously, we've had hyper low interest rates last decade, but we've also had interest rates in the double digit percentage points, in the 70s and 80s. And so in this kind of economic environment, what would be a reasonable expectation for, a 5 to 10 year outlook for a 10-year Treasury yield? Obviously very important because of how it impacts mortgage rates and other, key credit rates throughout the economy.
Yeah, and that's a great question. And historically, if you wanted to produce a crude estimate of where 10-year Treasury yields should be, it's somewhere around the trend in nominal growth. I think reasonably speaking, we can argue that the longer term trend in nominal growth has probably risen from a 3.5 to 4% to more like a 4 to 5%. So it's risen and it's also become more volatile. And that means that 10-year Treasury yields need to rise with that trend in nominal growth. So I would say a normal 10-year Treasury yield for this environment might actually be about a 4.5% or just a little bit north of where we are today. So to me, higher for longer means somewhere in the 4 to 5% range for 10-year Treasuries. And likewise, although this wasn't the question that was asked, I think it's important to also keep in mind what a higher for longer might mean for the Fed funds rate. Similarly, you're probably looking at an environment where nominal growth is 4 to 5%. So the Fed funds rate probably has to be around that level as well, maybe on the lower side, 4%. So a long run expectation of where the Fed funds rate might average might be around 4%. If you get some optimistic, or should say positive trend in inflation where it dips lower and we still maintain strong growth, then you could see the Fed funds rate maybe in the 3.5 to 4% range. But either way, the days of 0% or even 1% emergency Fed funds rates are probably over for quite a long time. And I think we're looking at the entire curve somewhere around 4% to 5% as a quote unquote normal going
Right.
forward.
And that represents a meaningful change from the prior decade, even if it's not, reapproaching that 10, 12, 14% level on the Treasury that we saw in the 70s and 80s. So a different world for corporate operators, a different world for consumers, and just kind of a new normal here to get used to. Tom, thank you so much for the time as always. Very insightful, and we'll hope to talk to you again soon.
Thank you.